Hey Shane, how's it going?
It is going, my friend. Up day, rally day here for the market so far. Even on some bad economic news and bad stock news coming out this morning. Markets up a little bit.
It is. And let's kind of jump through some of the macro stuff here. And just for everyone watching, today is June 2nd. And what we're looking at right now, so I've got the SPY up and nothing really big to report. So you zoom in a little bit. We're just kind of at this level where I had drawn that before, I think right at 410. So backing and filling a little bit on that, I think 416 is really a level where then starts making me think maybe the picture's changing, but we're still under the averages, pretty extended on the downside. So no surprise, I don't think, since a little bit of a rally is expected here. What are your thoughts?
Yeah, I mean, we were talking, I guess, earlier today in our company chat that you saw a little bit of a tradable bottom on the S&P 500 index right now, and my comment was I don't see anything bullish about this chart. And so I just see I see a I see a higher or excuse me, a lower high, right, on the S&P 500. And I don't, until we break through, at least that 416 level, I don't see anything to get excited about on the long side. um, the Fed is maintaining a talkish tone. Means they're more likely to continue tightening monetary policy, both through raising interest rates at their upcoming meetings, and then also through, as of what's today? Today's second. So as of yesterday, they're letting the balance sheet, I guess, roll off is the term. So what that means is that when they have bonds mature this month, they will not be replacing them with new bonds. And they set some limits. I think it was, I don't know, 30 billion, 45 billion. I can't remember exactly what the numbers were offhand, but until September, they've got a limit to how much they're going to let roll off. And again, that roll off just means not be replaced with new bond purchases. So things will mature. Uh, and ultimately, what the Fed's going to do with that money. So when you have a bond that matures, maybe we should just jump into this real quick. When you have a bond that matures, right? If I loaned Apple money, or if I loaned Google or Amazon or anybody money, when the bond matures, I get all my principal back at the par value of the bond plus my final interest payment. Um, and in the Fed's case, what they mostly own is U.S. Treasuries, right? Those are so they didn't loan the money to Apple directly. They owned it. They loaned it to the U.S. federal government, and also in some mortgage-backed securities. So I guess that would be banks, big banks. But just focus on the fact that most of the bonds that the Fed owns are issued by the United States government. So when the bond matures, the Federal Reserve Bank gets its final interest payment plus the par value of that bond from the U.S. government. And what the Fed's going to do with that money, rather than putting it back into the bond market and buying a new set of bonds from the US Treasury, they're basically going to light that money on fire. They're going to torch it. And what that has the effect of doing is taking dollars out of circulation, right? Which means every dollar that remains in circulation becomes a little bit more valuable. And it also has the effect of raising interest rates, because it removes the largest buyer in the treasury market from the table. So they're no longer buying bonds, which changes the supply and the demand function materially, right? The demand goes down because when the largest buyer in any market steps away from the table, prices tend to go down because the person who is responsible for the most demand is now gone. So in this
Right.
case, it's not a person, it's the Fed, and the Fed's buying bonds from itself, essentially from the US government. And now as those bonds mature, the government will print money, right, to pay the bond off. That's how we make our payments. That's why we've never missed or defaulted on a bond, is because we have the printing press. So we just print more money to pay off all of our debts, whether it's to the Fed or to China or whoever, or to citizens, whoever owns those bonds. But the only person who owns bonds that's going to light the money on fire when they're paid off is the Fed. Nobody else is going to do that, right? When I buy a
Hmm.
treasury and the Fed pays me back at maturity, I take that money and I pay for college, or I pay for a new car, or I go put it to work elsewhere in the economy. So this is one of those situations where the money comes out of the economy, the dollar becomes more valuable, interest rates go higher, and all of that has the effect of reducing the present value of anything priced in dollars, right? Whether it's gold or stocks or bonds or lawnmowers or gasoline. And that's what the government wants to do, is they want to reduce the price of things, which will bring inflation down, and that is their objective. So wasn't really planning on getting into all that, but I think it's important for people to understand, what does it mean when we say that the Fed's going to reduce the size of its balance sheet? What is quantitative tightening compared to quantitative easing? And so they were printing money and pumping it into the economy. Now they're taking money out of the economy and lighting it on fire. And so, all that printing money and injecting it into the economy made prices go up. Bonds, stocks, gas, milk, you name it, made everything go up.
Right.
Now the inverse is going to happen, and it's only just beginning. So that's going to keep pressure on the markets, I think, until it finally breaks the markets. But in 2018, when they did the same thing, quantitative tightening, the market grinded higher, from about June all the way through October, November, before it finally started tanking, and the Fed backed off and stopped quantitative tightening, but not in time to save the market for the year. 2018 was the last year that the stock market was down. So I don't see any reason that this year should be any different if the Fed continues on its current path. I expect a new low in the stock market, whether it's in the short term in the next couple of weeks or months, or sometime before the end of the year. And I wouldn't get excited about aggressively buying stocks until the Fed stops being hawkish, or they don't have to start easing, but they might have to stop tightening in order to get me back to the aggressively long camp. So
Absolutely.
that's a good summary, I think. Sorry for taking over and doing that, but do you have anything to add on that, or any other thoughts or comments that would be helpful?
Nothing to add on that. It just simply is, we had this environment where the Fed was trying to be as accommodative as possible, and they are now stepping away. And that just doesn't create a great backdrop for stocks to go higher.
Yep.
So, and on this, just if you wanted to take that trade we were just talking about, what that's referring to is you could go long here. You could put a stop right under the candle here at about 407. Your target is right up in here, just under the 200-day moving average is probably where you'd be looking. So 438, but this is a low probability setup. This is not, you don't make a trading career by taking trades like this. This is just potential little bottom or bounce that might be in there, but
sitting at the gambling table too long, and so you gotta make a bet or get up and go somewhere else, right?
Absolutely. So this is a better time to it's start of summer. Kids are getting out, go do something outside. It's just not a great time to be in there right now.
Yeah, it has to get above the 50-day moving average too, which will, usually represent a little bit of resistance. So I don't think that's a great risk reward, but yeah, I had a client call earlier today who wanted to jump into oil and gas, which is already up a lot. And I was like, man, it's the only place that's worth jumping in. But make sure you know your exit strategy before you get in, because when these things come down, they're going to come down hard and fast, and you need to you got to define your exit before you get in, because once you're in, you're now emotionally attached. There's money on the line, and trying to figure out a stop when things are all going against you is very difficult to do. So just like anything else, if you're going to buy, define your risk before you get in. Like the mobsters of investing, don't ever go into a room you don't know how to get out of, right? So
Yep.
that's the deal. And yeah, if I were going to buy it here, that's exactly where I'd put my stop.
Yep. So, and then, take a look at the cues here, and nothing. It's really that same kind of setup. You could also be the person taking the other side of the trade here and go short right now, and you could risk the top of this candle to the left. That's a really nice risk reward. See how those odds work out, but you're risking pennies to make dollars on something like that. So who knows? Again, it's just long-term downtrend, and just no great trades in here.
Yeah, I'm really kind of surprised at the bounce here in the NASDAQ today. We had Microsoft came out this morning and cut its guidance.
And I'll pull that chart up for anyone watching.
Yeah, so Microsoft cut its guidance and dropped 3%, at the open, and now it's even climbing higher. So I don't know. There's not a lot of volume out there. Volume's been pretty steadily declining for the past couple of months. So not a lot of people selling, not a lot of people buying either. And right now, I think the market's just rallying on low volume, and who knows why, or who knows what news is going to come out in the next couple of days that will support today's rally. But yeah, I'm surprised that on Microsoft cutting its guidance for future sales and profitability, that the market would rally like it's doing today. But but the market has a knack for surprising people. So not much surprises me anymore, and it's just a one-day event, so you never know if it's going to last or not. But I would expect that more companies are going to come out and cut guidance now that we're halfway through the year. The reason that Microsoft came out and did this, and Snapchat did it a couple of weeks ago. I'll share a chart on that. If you want, I can do it. I can do that now.
Yeah, if you want to queue that up. And I was going to point out one thing. So on a trade like this, you've got a trend going down since kind of December, but look at this. So overnight, think about it. That news comes out, sells off down there. Now we are right at where it closed last night. So anyone looking to get out right now is a great time to be getting out. And that translates to, if you're looking for a spot to get short, another great risk reward entry. I mean, you could short it here. You're right near that close, and you could put a stop a little outside there. And I wouldn't be surprised at all to see it sell off here, but just from a trading standpoint, that'd be a nice little setup there. But let me turn it over to you, and I'll let you share your screen.
All right, cool. So this is a Snapchat chart, and I'm gonna scroll over here. So back in February of 2021, Snap on its earnings call that day, right? Same day as earnings, which they looks like they missed on their earnings but beat on revenue. They said back then that they were on track for several years of 50% annual growth in revenue. That's what they said in February of 2021. And from there, the stock rallied, 18% over the next couple of days, then dropped about 16%, but overall worked its way to an all-time high, about 40% higher over the next couple of quarters after they said that. And from there, it has been a one-way trip down. So fast forward to their April of 2022 earnings call. Snap gave forward guidance for growth at 20 to 25% going forward. So, a year ago, they were expecting 50% annual growth for several years. That's how bold they were in calling that. And after the stock had already dropped, 63% from highs, and a lot of that's due to Apple changing its privacy rules and being a little bit harder for marketers to advertise to specific, people groups and demographics. That impacted Facebook and a lot of other companies as well, but Snapchat really took it on the chin. So, the stock dropped 60%, and their projections for future growth got cut in half by this April. Well, check this out. It got worse after that. Fast forward to, I'll zoom in here a little bit, but less than 30 days later, or I guess a little bit more than 30 days later, on May 23rd, from April 21st, Snap filed an 8K, Form 8K with the SEC, warning that the macroeconomic environment has deteriorated further and faster than anticipated since company issued guidance at end of April. So in 31 days, roughly, things deteriorated so far that they said, first it was 50% annual growth for several years. Then they cut that in half to 20 to 25% revenue growth looking forward. And about 31 days later, they said, we're not even going to hit the 20 to 25% number. And Snapchat shares have just been pummeled. We are now down almost 82% from the all-time high in September of 2021. So There's a whole bunch of other stocks out there just like this, but ultimately what happens is we get halfway through the year and companies begin to see, they see what's going on, and they see that they're not going to meet or beat their earnings guidance. And if they miss by enough, they'll get sued by investors, right? If you're investing in a company and they tell you that they're going to grow by 20 to 25%, and then they wait 3 full months or a whole quarter to tell you that they missed that guidance when they knew ahead of time that they were going to miss that guidance, that's when the ambulance chasing attorneys start coming out and filing class action lawsuits, and that's always a big hassle for the company. So the company, as soon as they know, well, usually not as soon as they know, but when it becomes indefensible not to tell the market that they're going to miss their prior guidance, that's when they put the information out. So there was no earnings call on this day. There was no other event. They kind of behind the scenes filed this document with the SEC, and kind of probably hoped nobody would notice, but the market did notice, and I would expect more of this to happen. As we go forward, we kind of get to the middle part of the year. Other companies like Microsoft, for example, and others are now going to know that they are not going to meet full year estimates, and they might start reducing their guidance. Analysts on Wall Street might start reducing their anticipated earnings for the year. And as that begins to happen, the market may grind materially lower. And also, forward price to earnings ratios will go up when that happens. So forward price to earnings is based on projected earnings, right? Current price based on projected earnings over the next 12 months. Well, if the companies are lowering their guidance, what do you think the analysts are going to do with their projected E in the PE ratio?
Right.
That's gonna come down too. And just this is how division works, right? If you're dividing the same number by a lower projected E, so if the P stays the same and the E drops, the ratio goes materially higher. So from say a 17 forward PE, which looks pretty cheap on a historical basis for the S&P 500, if the projected earnings drops by enough, that PE, that forward PE is going to rise from 17 to 18 to 19 to 25. And even though the market's down 20% already for the year, or 15%, wherever we sit today, stocks might still look expensive based on the forward projection of earnings. So there's a whole lot of bad stuff that could continue to happen with the Fed tightening into a slowing economy. And I think there's more downside than upside presently. So market can rally all it wants to today. It's not going to change my opinion.
Right. Yep. And I agree. So do you want to flip the screen back over?
Yes, sir. I will stop sharing now. All right, you're up.
Perfect. So, we looked at Qs, go through oil and some of our commodity names here. Again, that white arrow, it's still holding, so drew it perfectly. And I mean, oil, I love that trade. That is bullish, and I do not see it going anywhere else.
Yep, oil and gas is a good place to be. If you're entering here, just make sure you predefine your exit so that you know when to get out. Oil is a boom bust business, as all other commodities are. It's a cyclical thing, so goes through periods of booms where it rallies higher than anybody thinks possible, and then it goes through crashes where it goes lower than anybody thinks possible, like it did, like it went negative, last year during, well, I guess, was it last year or year before? I don't know anymore. But when nobody was flying, nobody was driving, nobody was cruising on cruise ships, oil went negative. So it's a boom bust deal, and right now we're in the boom phase. So if you're entering here, make sure you know where you're getting out when things finally turn around. But I don't see any reason for this to go down. The one thing, and maybe this is hard for people. It's certainly hard for me sometimes to keep competing ideas in my head together. But as the value of a dollar goes higher, all else equal, one barrel of crude should cost less money, not more.
Yep.
So seeing the dollar and crude rally together is kind of an anomaly, but all else is not equal, right? Like, so in a perfect world, with all else equal, a rising dollar is going to lead to a lower price per gallon of gas, and lower price for barrel of oil, and lower price for an ounce of gold, and everything in between. But everything isn't always equal, and the supply and demand function with Russian oil being taken offline and all the different geopolitical stuff going on with oil, I think there's and demand increases now that, you know, countries have reopened and allowed people to eat at restaurants and go to movies and whatever else. All else is not equal. So the dollar and crude oil can rise together. You know, it's not a directly linear relationship because there's a lot of other factors at work, not just the value of a dollar. So
Absolutely. So always important to remember that all commodities which are listed on the futures exchange, they are all denominated in US dollars. So, certainly plays a part there. So, all right. And then gold. I love this chart. And this is, I can't tell you how many times I've said, oh, this is it. This is the rally. But, for a trade, this is awesome. I love it. Came down, tested the 50-day, or yeah, the 200-day, and rallied back off that. I think this is a great one for the time being. Seems to want to go higher, but
Are you in a trade yet? Did you take a long position yet?
no long on gold on this one.
No.
It's
How big is that bar right there? What's the risk to the lows of the day today? If you bought it right here, how far would it have to go down to make a new low for the day?
So 25 points is what it moved. So that's the full range on this bar, which that's a pretty good move for gold. But
if you hover your mouse over that bar, it'll tell me. Yeah, so it's up 1.34%. The low's 1.846. So yeah, okay, cool. Well, if I were buying it here, which I don't hate, I would put my stop at the lows of the day. And as long as it keeps going higher, then you're in the trade. And if it makes a new low for the day today, you would be out.
absolutely. So we'll see on that one. Gold it loves to frustrate people. So we'll see what it does from here. But right now it looks like a nice little bounce and could work its way higher.
It just doesn't move that fast. Like, I mean, that's only 1.5% risk to the downside. It's only up 1.3% today. So I mean, you could take a full position on that and you're still only risking 1.5%. And if it went back to highs, that's 10, 11% upside. So I mean, it's still like a 10-to-1, 9-to-1 risk reward ratio. It's not bad, but it just moves slow. So that's why I would end up looking at like some of the gold companies. GOLD is one ticker, and some of those, GDX, the gold miner, ETF would be a good one too.
So, and then let's take a look at the 10-year. This one, we've drawn our lines before. That is just a bullish looking chart, and I don't like it. I don't like the high rates, but it just seems like that's where we're going.
Yeah, personally, as a person looking for a home, I don't think that's a good time to be doing that. But getting forced into it, it seems like.
Yeah, tiny homes are really catching on, right?
Yeah, so. I got a tent you can stand for a while. But yeah, no surprise to me that thing pulled back right to the 50-day moving average, that red line, and then started ripping from there. So that can easily go higher. Mortgage rates can tick back higher. Looks like mortgage rates still sitting at 5.10, same place we looked at them last week. So I don't know. I haven't really been keeping up with that over the past 1 week. I'm not sure how they've moved around.
Yeah, and it's interesting on that one. I think it must just be an update lag. But I talked to a mortgage broker and it was looking more like kind of 5.8 is what 30 years are starting to hit. So
5.8.
5.8.
Click that mortgage rate down there. You got it. Yeah, that one. 5.8 is way higher than where it's ever even been recently.
With where it's updating on that one. So I don't know. I'm curious. I'll find out exactly when that one updates. But I wonder too on that is so I understand, the 10-year is the base rate that it's going off of, but then you've got credit risk and some of that in there. And given the macro backdrop, I wonder at which point the credit risk is going to start coming into that.
Yeah. No, I totally. I think I don't know if we mentioned it last week on the call, but I don't know what they're doing with credit and whether they're getting tighter on their lending standards and all those kinds of things. But yeah, the Fed is trying to equalize the supply and demand imbalance in the housing market by raising rates. They're literally trying to price people out of the market by making the mortgage cost more, and they are succeeding. And if you zoom out a little bit, so I can see a little bit more of that chart. I like looking at these on a really long-term basis because these are, longer term moves for the most part. So yeah, I mean, to me, watching that pull back to where it has right here at 5% doesn't surprise me. I think TradingView updates this on a weekly basis. So I don't know what day of the week they update it, but I would not be surprised to see it continue higher up into that 6.8 or almost 7% region before getting any meaningful, pause. So
Yep.
I don't know. That'll break the housing market pretty good if we start seeing rates at 6 or 7%. That's I mean, in my lifetime, that's not something I've ever had to. In my lifetime of buying a house, I should say. When I was born, rates were much higher, but I
Right.
wasn't. I wasn't in the market then, so I don't remember it too clearly.
Yeah. Um, and then the next one, so we'll pull that up. I just
Glad
like
I
this.
glad I got out.
Yeah, so that is the power of a stop. The
Yep.
fundamental story, everything told you stay long, but look at this, where we've broken down now. I'm starting now, I would start looking for a short.
Yes, sir.
We've broken some key levels. Yesterday was a pretty big day.
Yep.
So it broke down pretty hard. And yeah, that chart now is maybe a short, but would not be wanting to go long on that one.
No, if I want to short it so bad. I couldn't find any shares to borrow yesterday when I looked. But I would short it all day right here with the stop at the 50-day moving average. Again, a close above the 50-day moving average would get me out. That's at 10.88, and you could short it at 10.71 right now. So not risking very much. And we can easily go all the way back to 850 from here. So risking 20 cents to make $2, do that all day.
Absolutely. So, and speaking of trades you've done, NetEase. So we talked about this last time, and what we're looking at is this trend line break.
Yep.
And you and I, we were talking the other day when this red candle came in, and you were a little nervous, maybe you were going to get stopped out, but it has kind of reclaimed all the sell off there. And what do you think? My vote is I like it. I would have loved to have bought it yesterday, but it's looks pretty good in my opinion.
Yeah, I mean, I wouldn't have bought it yesterday just because you know me, I like to buy things that are going up, not down. So I would not have personally bought it yesterday. I thought I was going to stop out yesterday, so I'm glad that didn't happen. My stop, gosh, I gotta look and see where is my stop on NetEase. I'm gonna tell you. Give me 1 second. My stop's at 99.44, and my entry price is 101.14. So I'm risking I don't know what, $2 basically, not even two whole bucks. And who knows how high this thing can go. But I'm now the 10-day moving average, which I don't know if you have. Yeah, you don't have it on your chart, I don't think. But the 10-day moving average is now above my original stop of 99.44. So the 10-day is now at 99.73. So probably starting today, at the close, I will move my stop for at least some of the position up to that 10-day moving average and use that to get me out with some profits for at least some of the position. I like to sell 10% when I'm up 10%. So not up 10% yet by any stretch of the imagination. I'm up 101 to 105, call it 4%, something like that. So it's going the right way. And again, I'm not risking very much. And I hope to be in this trade for as long as this thing continues to go higher, weeks or months or years. No big deal to me. I don't like trading actively. I like finding positions that can rally and continue to grind higher for a long time and hold them for as long as possible while they're going up. So that's my plan for now. And again, you lock in gains by trailing a stock price that's running higher with some sort of moving average or other levels. So that's where I'm at with that one. But yeah, I'm glad I didn't get stopped out yesterday. I really thought that might have happened. It was actually trading below my stop level for, I don't know, maybe a half hour or an hour yesterday. But it never closed down there. So got an end of the day rally, and it was very close to stopping out, but
So
just didn't
then
quite do it.
do you use a mechanical stop or do you use a mental stop and get out at the end of the day if it closes?
I set alerts, so I set alerts at those levels, and I'll get a ding or a text message or whatever. Usually a text message and a ding, and I'll look at it. Sometimes I'll take some off intraday if it just dips below my number. But usually I don't have very many positions at any one time. I mean, so it's not that hard for me to babysit a couple of trades. Like 10 positions is the most I should have pretty much any time. So I just kind of make a mental note of it. If I get one of those dings, and then add a new stop at a new level, or add a new alert, I should say, at a new level. But I don't have any stops actually entered into the market right now. Like there's nothing, because again, I'm at the desk all day. If I was going to the
Yeah,
golf course, or if I was going to be in the car or going on vacation, I would actually enter some stops into the market at various levels. But when I'm sitting in front of the desk all day, I just create alerts and go from there. But on a closing basis, if we're 10 to 15 minutes to the end of the day, and I can tell it's going to close below whatever my stop is, I will sell it. I'll just get out.
gotcha. Good stuff. Well, yeah, another one's a Bitcoin. You wanted this one on here today, and I know a lot of people watch it. So I'll go
Yeah.
out on a limb and say what I think on this one. I think it looks pretty ugly. So we had a nice recovery bounce here, but just this candle yesterday, it sold off pretty hard. It's sitting here now. I think that's setting up for
Yeah.
a nice little short. What do
Can
you
you
think?
put can you just click that green line that's going through like the current price right there? Like double click that green line, and under coordinates, change it to 28,500. Just type in 28,500. There you go. All right, so that's where I have it. A close below that 28,500 says get out now. As long as it holds that level, I think it might hang in there. But man, it tried to bounce. It couldn't even rally up to the 50-day moving average before it got sold again. That just tells me there's probably some more sellers out there it's going to prevent it from going much higher than that 32,000 range that it got to over a few days ago.
Mhm.
It just, to me, this thing looks atrocious. I wouldn't be shorting it or anything, but under that 28,500, I think it easily drops to that low candle right around where your mouse just was at like
Yep.
25,000. And if it doesn't hold 25,000, 14,000 is not out of the question, which would be right. 13,800, 14,000, that's an 80% drop from the highs, as I think we've talked about maybe a couple of weeks ago on this call. So yeah, Bitcoin looks pretty brutal. And there's just been a bunch of weird stuff going on in the crypto market with like, Solana was down for a bit yesterday, and some of these, this Luna coin had failed. Mike Novogratz got a Luna tattoo, and it like, Luna 2.0 came out and failed almost immediately. Like, I don't know. There's some weird stuff going on in the crypto market. There'll probably be winners and losers, during that time, but I don't think there's a lot to get bullish about here on the Bitcoin chart.
No, absolutely. And I'll just zoom out really quick. I always like to look at a weekly, so just a higher time frame and see where
Whew.
that's at.
Yeah.
And that's an ugly chart.
Yeah,
So
it needs to hold this 28.5 level. Otherwise, I mean, yeah, it gets ugly quick.
mhm. So, and then I'll just go back to daily. And then I just wanted to hit Apple and Tesla just because we've talked about them. I don't really have anything new to add. Same as kind of NASDAQ and ES. It's right up at this resistance level. Has not taken out yesterday's high. If it does that, maybe it changes the picture a little bit.
Yep.
But right now, it's just there's no trade here. It doesn't mean it's broken, but there's just kind of nothing going on right now. I think if I had a full position, I would maybe lighten up a little bit, but that's about all I would be looking to do.
Yeah, I'm actually surprised it didn't break down hard at that 138 level. It just kind of hung in there, which is great. I mean,
Mhm.
good for Apple. Good for all the people who are still holding some of it, including, us. I'm not taking any more off the table here, but the thing that just jumps out to me is this death cross that's about to happen. So the red line is about to cross the blue line there, and so the 50-day moving average is going to cross the 200 from above, and it just doesn't mean that the stock has to immediately go down. It can trade higher, but to me, you want to be invested when those things are separating, with the 50-day moving average moving away from the blue line, the red line moving away from the blue line to the upside. And that's not what you see happening. So again, odds probably not in your favor here for a trade, but long-term holders, can still hold on to some.
Yep, absolutely. If you're a long-term holder here, nothing to be alarmed. It's that 138 level you and I've talked about before. If it closes below there, then that starts to, maybe trigger some stops. But right now it's just kind of in no man's land, no new trades. And if you're existing shareholder, nothing big there. Tesla, so I think you were short Tesla and maybe a personal bias there. But yeah, it came down, retested this level, which I had drawn that one before, and moving higher from there. But I don't know. Just personally, I think in the face of what appears to be a bear market, I don't know. It's an okay trade, but I just feel like I really have to read the tea leaves to find something.
Yeah, 50-day already below the 200-day on that one. So, a relief rally is probably in order. Tesla, to me, I like the idea of shorting it. I was actually short this thing yesterday, and I just stopped out of my short on that this morning, right? So if you look at yesterday's candle, I shorted it yesterday with my stop at the highs yesterday. So I stopped out today when the candle went above the highs from yesterday's candle. So had a little bit of risk on there, and it was only a half a size position because I wasn't too confident in it. But I thought as of yesterday, those two red candles to me looked like it was gonna go down and test the lows, if not make a new low. So today's action in the markets it's weird that the Nasdaq especially is rallying so much on Microsoft coming out with bad guidance, reducing their guidance and saying they're going to make less money and do less revenue in this current economic environment. And then suddenly everybody wants to buy tech stocks. Doesn't really make a lot of sense to me. And usually when these kinds of moves happen that go counter to the economic evidence that came out on that day, usually they get erased pretty quickly over the coming days or weeks. So yeah, I'm surprised to see the market rallying, but I'm not going to stick with shorting Tesla while it's ripping higher in my face. I mean, that's why does it feel good to sell something for a loss? No, but as of the end of May, in May, I had a 53% win percentage, which is high. My win percentage on my personal trading account for the year is 40%. So I made money all year, haven't been down for even a day all year. And I'm only making money on 40% of my trades overall.
Mhm.
Last month was probably my best month of the year at 53% win rate. And again, you don't have to make money every time. So every time you close for a small loss, you're one step closer to the next big win. So small losses and big wins is how you make money actively trading. And again, I don't like to be in a stock for only one day. Like I wanted to be short Tesla for the rest of time. I short that thing all the way to zero, because if you zoom out, this thing can go to 500, no problem.
Absolutely.
So when it finally goes down and puts in a new low, like there's no reason it can't hit that 544 level is what I was thinking about. And no reason that it has to stop going down there either. So yeah, I like to make trades where, I can be in them for a while and I can sit on them. But if it goes against me and it breaks my stop, that's it. Like game over. Today I didn't even wait for Tesla to close above the highs yesterday. As soon as it went above the highs yesterday, I said, screw that, I'm out. I will look for a new opportunity to short this thing some other time. And, if it's going to break out and go materially higher, I got no problem buying it for a trade either. It doesn't mean I fundamentally believe in the company, but you don't want to fight the trend, man. So that's the name of the game.
Absolutely. And in this market, there's going to be rallies, and it's just important to be tactical and have the brakes on, exit trades when they go the right way and then they break on you. Just get out. You manage risk like that and you're going to be successful. But right now there's just no clear trends and there's a lot of storm clouds on the horizon, so to speak.
Jamie Dimon called them hurricane clouds. I think he's trying to talk the Fed into slowing their roll on the hawkish side. But
Yeah,
if you go Google Jamie Dimon and his recent comments, it wasn't too bullish. So he runs the biggest bank in the world. He kind of probably has an inside track on what's happening out there. So anyway,
absolutely.
man, I gotta get running. I don't know if you guys see the shirt, but I got the Nerd Street Gamers quarterly board of directors call coming up after this. Nerd Street Gamers is an esports company out of Philadelphia. They've got locations all around the country. Go to, I don't know, I think nerdstreet.com or just Google Nerd Street Gamers. You'll find their website. Maybe they got a place locally, or maybe they've got an online tournament that you could check out. But this is a company that we've invested in for a few years, and very proud of that investment. Very proud of the company that ran a brick and mortar business all through COVID and didn't fail. You know, as a young startup company, just getting going, you know, having the government force you to close all of your in-person facilities and having no online presence at the time, and then surviving through that is just a big testament to the management team and the business model. These guys had run almost no online tournaments when COVID hit. They were an in-person esports company, and they managed to grow revenue through COVID by pivoting to some online offerings, some software and service offerings. And now they host tournaments for all the biggest publishers in video games, from Activision Blizzard and Tencent and, you know, Take-Two. They host everything. They've got deals with every major publisher, and they're just killing it. So with the economy kind of reopening, as we've alluded to a couple times in this call, people getting back out there doing things in the real world and having experiences in real life instead of just online. We're really optimistic about what the potential is for this company's growth, and I look forward to hopefully talking about the Nerd Street Gamers and their ticker symbol someday when they go public. So if you guys are interested in checking out the company, just Google Nerd Street Gamers and see what they're all about. And if you have interest in making an investment in that company, we're not currently raising a round or anything right now, but give us a call, let us know. And by the way, I'm going to say, Kyle, you should post our email or our website or something in the show notes so that people can send us questions that we could answer on upcoming calls. So if you have a question on anything that we talked about today, or a question about trading or economics or portfolio management that we didn't mention or reference at all today, feel free to just send us an email at info@elevatecapitaladvisors.com. or go to our website, elevatecapitaladvisors.com, and click the contact form and send us your question that way. And we will we'll collect those and do our best to answer each one of those, either via reply email or on an upcoming session. So anything else to add, Kyle?
I think you covered it. And just so everyone knows, you know, Nerd Street, so that is for qualified investors only. So you can look up the criteria there, but need to have some pretty substantial net worth to get in there. But
yeah, qualified client is the terminology that you want to look for.
Absolutely. So awesome. Well, Shane, thanks again. Enjoy the meeting and see you next week.
All right, later on. Thanks, man.
Yep. See you.